Millions of people across Britain are heading into retirement right now with incomes that simply won't keep up with the cost of living. And the scary part is, it's not just people who never bother to save. It includes ordinary, hard-working people who genuinely believed they were doing everything right. Welcome back to Pension and Benefits Guide. This channel is all about helping you understand your pension, your retirement options, and how to plan for a future that actually feels secure. Today's topic is a big one, so stick around. New research shows that nearly 1 in 3 people in Britain are on track to face what's called pension poverty in retirement. By the end of this video, I'll walk you through what's causing it, who's most at risk, and what you can actually do about it. According to Scottish Widows' latest retirement report, around 31% of adults in Britain, that's roughly 12 million people, are on course to face pension poverty. Now, pension poverty isn't about missing out on holidays or little luxuries. It means not having enough income in retirement to comfortably cover the basics: food, heating, everyday living costs. The report defines it as falling below a minimum retirement lifestyle, broadly measured as around 60% below the median income after housing costs. In real terms, that's less than roughly £10,000 a year for a single person, or around £17,000 for a couple. And here's the part that really stands out. This isn't just affecting people who never worked or never saved. Many at risk have worked and contributed their whole lives, they simply haven't been able to keep pace with rising living costs. So why is this happening? The cost of living has, in many cases, risen faster than people's retirement savings. The report warns that if fuel and energy costs stay high, even more people could be pushed toward pension poverty. And when bills, food, fuel, and rent eat up more income, retirement saving is often the first thing people cut back on. Small reductions today can turn into big shortfalls decades later. The report also questions whether minimum pension contributions are too low. Right now, auto-enrollment requires a minimum total contribution of 8% of qualifying earnings. Many experts believe that's nowhere near enough, especially for younger workers facing higher housing costs. In fact, Scottish Widows estimates that raising contributions from 8% to 12% could cut pension poverty among defined contribution savers from 31% down to just 13%, a massive difference from one single change. Another issue is over-reliance on the state pension. It forms the foundation of retirement income for many, but it was never designed to fully fund a comfortable retirement on its own. Without meaningful action, this gap could widen over the coming decades, particularly as Gen X approaches retirement with some of the lowest savings levels seen in years. If any of this has got you thinking about your own retirement plans, that's exactly the point. At Reeves, we offer a free, no-obligation pension and retirement health check to help you understand exactly where you stand. Whether you've got old pensions scattered around or you're just not sure if you're saving enough, our team can help. Link is in the description below. Quick pause: if you're finding this useful, hit like, drop a comment with your thoughts, and subscribe if you haven't already. It genuinely helps this channel keep making videos like this. Now, who's most at risk? Self-employed and part-time workers are a big concern, since many fall outside automatic enrollment entirely and miss out on regular contributions and employer funding. Scottish Widows found around a third of people in both groups are projected to fall below minimum living standards in retirement. Gen X is another key concern. Industry experts warn this generation has some of the lowest retirement savings seen in decades, and Standard Life has warned the retirement income crisis could peak during the 2040s as more Gen X workers begin retiring. On top of that, many people are forced to leave work earlier than planned, due to ill health, caring responsibilities, redundancy, or burnout, which cuts down contributions during the most crucial final years. But here's where it's not all doom and gloom. Lower short-term energy costs have eased pressure on a lot of households recently, though ongoing geopolitical uncertainty is putting pressure on global energy markets again, a reminder of how quickly things can change. That's exactly why financial planning isn't about predicting the future perfectly, it's about building a plan flexible enough to adapt. The report also found more people are building non-pension savings for extra resilience, and more people now expect to retire owning their home outright, with many overpaying their mortgage to get there. Which can make a real difference to retirement affordability. Pension poverty is not inevitable. Better saving habits, lower living costs, or smarter long-term planning can genuinely improve outcomes. So what's the big proposed solution? Raising minimum auto-enrollment contributions from 8% to 12%. For younger workers, the impact could be dramatic. Workers aged 22 to 29 could build up as much as an additional £114,000 by retirement, with average pension pots increasing by more than £40,000 overall. That's the power of long-term saving and compounding. There are also major, sometimes controversial, reforms being discussed. In the 2025 budget, Chancellor Rachel Reeves confirmed that national insurance relief on salary sacrifice pension contributions will be capped at £2,000 a year from April 2029. Salary sacrifice has been one of the most tax-efficient ways to save, so this raised concerns across the industry. To be clear, this doesn't mean salary sacrifice is a bad option now. Some perks have simply been reduced. It's still an effective way to save for retirement. So what can you actually do right now? First, even small increases in your pension contributions add up over time. You don't need to double them overnight. Second, don't rely solely on the state pension. Treat it as a foundation, not your entire income. Third, review your old pensions. Many people have multiple workplace pensions they haven't checked in years.